The topic really starts with this slide that I've put up in front of you. Population dynamics, what we do know. And obviously earlier on we heard about people talking about what they think, and these days with the internet and all the digital media, it's the bulk of what you see there is what people think, not necessarily what the data says. And what the data is telling us is obviously population growth rate has declined dramatically, and it's projected to go down to almost zero at some point. But now that's a projection, and I'll talk a bit about those later. And the whole topic, as you would have seen, was about an expansion of the population in the world to increase by another 1 billion people from where we are at this point in time. And clearly, if you projected at the growth rates that we know are in existence, you could quite easily get to that point, as shown on the slide. But the interesting slide is if you take the existing population at the moment, and I don't think I've got a little, oh yeah, I do, right, there we go. This is a slide that you can get off the internet, which is fascinating, which represents the world as 100 people. So it's all very well to say the population is going to grow by 1 billion over the next couple of years, and as a fund manager and people who are trying to exploit that, you've got to break it down into its components. It's absolutely useless to say, okay, now I'm going to invest in equities because the population growth is going to drive an improvement in equities, etc. That would certainly be the wrong way to do it. If you look at all of these breakdowns, I mean, age is fascinating. 66% are in the age group 15 to 64. Gender is 50-50, so you wouldn't slant your investment decision one way or the other. 75% of the world have cell phones. I mean, that's just, of all of these, that's the most amazing statistic that I saw, is that if you want to get to people, this is a medium that certainly you should be exploiting. And in our business, we've been at great pains to employ people that can deliver information through that source. The rest of them were actually, I thought, on the side of, wow, that's quite good. 77% have access to shelter. I didn't think that was the case, particularly when you look at Africa and South America. I thought it would be lower than that. This is no surprise. English is part of other. If you had to break this down into business, clearly English is the most common language in the business community, but across the world, not necessarily. So if you're going to market outside of Australia or you're going to buy things, you've got to be able to talk other languages. That one was quite interesting, but that's dominated by obviously Africa and places like South America. That is what we can thank our ancestors for, is that there's been a great push into literacy. And a little later on, I'll give you a couple of stock ideas, of which one is related particularly to that. But 83% are able to read and write. I mean, if you had wound that clock back some years, that would have been much less than that. So that's a very interesting one to me. But coming back to my original point is that it's absolutely useless to look at the 1 billion and try and make a macro call on the markets, etc., because population is going to expand. You need to understand the metrics of what's actually happening within that billion and where it's growing and where it's not and what people are doing. And like I said, that was the one that really jumped out at me. And this one here, I mean, we think that for us here in Australia, the internet is all pervasive. Everything happens on the internet, whether I'm going to book a flight or even just find out where I want to go and have something to eat. But 70% of the world don't have internet. So that's a massive opportunity for one to exploit the potential growth rate in those areas. We have 3 LICs. 2 are in Australian equities. What we call flagships is just a portfolio of the stocks that we think are the best in Australia. We have an X50 product for those of you in the audience here that have got exposures to the top 50 or maybe even less than the top 20, which includes the banks and some of the miners, and you really don't want to have that duplicated in a portfolio. So that's why we established what we've called the ECP fund. And then we have Berkshire Hathaway in a fund called Global Masters. And Global Masters was originally set up for people like yourselves to be able to get exposure to him, because it was, if you go back when this was set up sort of 15, 20 years ago, if you wanted to get exposure to the legendary Warren Buffett, most of us couldn't afford it. $100,000 a share, and you had to have a minimum of 100 shares. Good luck. I mean, I certainly wasn't in that game. But this enabled you to buy a share for $1, and you could buy 100 shares, and then you get exposure to him. So as he's got a lot older, there's been a decision to wind down the exposure to Berkshire Hathaway, which currently sits at 50%. And I thought I would lead into the rest of the discussion by just seeing what he has to say on this topic of population growth.
My question to you this afternoon is, how do you currently see this critical issue being tackled?
Yeah, well, population projections are just that. They're projections, and they've been notoriously inaccurate over the years. And the gentleman who made the motion referred to a recent New York Times story, and there are projections that, based on fertility rates and what happens to them in different countries under different economic conditions and all that. I mean, you can come up with all kinds of projections. I don't know the answer on it. Nobody does at any given time. And the carrying capacity of the Earth has turned out to be a lot greater than people have thought in the past. But there is some amount that does relate to the carrying capacity. It may have been expandable, but it's not infinitely expandable. And I would suggest that the errors of being on the low side in terms of population rather to estimated carrying capacity, the danger from those errors is far, far less than the dangers from overshooting in terms of population compared to carrying capacity. And since we don't know what carrying capacity is or will be 100 years from now, I think that generally that mankind has an interest in making sure it doesn't overshoot in terms of population. And if there's no great penalties attached to undershooting at all.
So I think the message there, and I've summarized in that slide, is that they're just projections. They're somebody's opinion. They're notoriously inaccurate. There's no doubt about that. But the overriding statement that the population is going to increase is absolutely true. There's no doubt about that. But he says he doesn't know the answer, and I mean, he's one of the world's best, so how would a mere mortal like me suggest any otherwise? And I'm mindful, and I see many people in the audience probably were around at the same time when the School of Rome got together. And they were looking at oil. And they basically said, oh, we're going to run out of oil pretty soon. There's a major oil crisis. And you better think about that in investments, and countries better think about how they're going to deal with this, because we're going to run out of oil, so we've got to figure out other ways of generating energy. And how wrong were they? Without a doubt. And those were all Nobel laureates that were sitting there in the think tank. So again, if the world's best are looking at the data and saying this is going to happen, maybe we shouldn't trust too many of the opinions that these people come up with. At the start of the whole COVID crisis, we were all looking at things that were happening on the television and news, and everybody thought the world was going to go to ZAT in a short period of time. People were fighting over toilet paper in the supermarkets. But for those that have a way of investing that looks at opportunities, you've actually made a lot of money in the period. So you've got to be careful about the consensus view and the media view. And very definitely, there's been a couple of UK fund managers who invested very heavily in Russia, and at the start of all of this said, no, don't worry, it'll soon be fine. Well, how wrong were they? Particularly as if you happen to listen to Jonathan's talk earlier on, where there was a major change to the world, where they actually sanctioned a central bank. And with all of the unintended consequences that's going to cause, but certainly that really hadn't happened before. A friend of mine pointed out, well, it did happen to Iran, but actually it was slightly different in that Iran had blown up a US building with people in it, and the family of one of the people sued Iran and got their assets. And then Iran tried to have it overturned, and then the US Congress passed a law that said they could, and then it was tested in the High Court, and the High Court said it was all fine. So that actually set the precedent for what's happened to Russia. But then it started by a family suing, not the government, and not the government coming out. So it's fascinating, but if you had have not listened to what he's been saying, as Jonathan said, he said, when an autocrat says something, you better believe it. I tell the guys in my team, when I say something, you better believe it. So, really, I'm on the same sheet as what Warren Buffett is. I think I'd be stupid not to be. And he says he knows if he should be buying a stock, but he's not quite sure when he should be buying it. So it's all about the timing. And the timing is difficult, and we've got a way of dealing with that in our business, as I'm sure he does. I'm not sure how he does a lot of things. There's a lot of people that pretend to know what he does, but he's certainly a mind of his own. But what I do believe is correct is that if the company has great products, it has a defendable market position, and it's got management that are aware and reactive to changing demographics, that you've got a winning solution. But obviously the business models have to be able to adapt and grow into new markets. So I'll talk a bit about that, because that's the thesis on which we operate. And clearly he buys into that. And what I would say is that even though we as fund managers, we have a really big team, which I'll talk about in a minute, but they focus on everything around the investments we have, we're still armchair experts. The guys that know what's going on are the executives. That's why I highlighted the management. Really, at the end of the day, we are relying on the management of that business, who are seeing things happen every day, being able to deal with it. And for us sitting in the background, to again make projections as to how they're going to deal with it could be quite wrong. So this is just a quick profile of us, ECP Asset Management. As mentioned, we started in 2012. We're currently managing about $2.5 billion for institutional money, and we've got the 3 LICs. It's 100% owned by the staff, which is a lovely model, because everybody buys into what we're doing. And we've got an interesting concept that we don't allow anybody in the firm to invest in anything other than what is in our portfolios. So every one of the investment team and the wider staff actually believe what we're doing, and they have to. Otherwise, their personal finances are going to go down the gurgler. We have limited capacity, so if people want to utilize our expertise, we've got a capacity limit of another $1 billion. And then we're done. So really, it's the LICs for people like yourselves that you need to look at if you're interested in using us as a manager. In the Morningstar survey, we're consistently in the top quartile, and if I put my Hyperion hat on, the 2 entities have been in the top quartile since I've started managing money in Australia. As any large investment firm would be required to do, we're a little boutique owned by the staff. Our GS007 is unqualified. We recently had our due diligence done by Mercer, who gave us a rating, which is they have a traffic light system, and we've got green for everything that we did. So that would be comfort to people like yourselves to use our products, knowing that a house like Mercer have actually given us a tick. That's the investment team. You'll see they all are of similar age. Youngest being 31, and the eldest being, I think, 47. And the reason I structured that team, and that excludes me, obviously, the old fool at the top, I chair the investment committee to make sure these guys don't go crazy and do some weird things. But obviously, it's more to test the ideas that they put on the table with a bit of gray hair and a bit of experience. But really, everything comes out of the guys that are in the team. And what I do love about young people is they're smarter than us, and I mean us collectively here, and they've got 10 times more energy than us. And that counts for a hell of a lot, especially in investments when you've got a lot of digging to do into backgrounds of companies, etc. We had 2 recent additions in the last year. In the middle of COVID, we hired another 2 people. And we also moved to new premises because nobody was leasing space in Sydney, and we got a fabulous deal. So we leased some big premises in the middle of Sydney, and we hired 2 people because through COVID we'd done phenomenally well, and we had inflows into our funds. So all of that precipitated us needing new space and additional resources. The investment process is really easily, not explained, but defined in this chart that I show you up front. And when you see the index tracking funds that have come to the fore, there's quant funds which dominate the marketplace. They really focus on this piece here, where you can assign a probability to some form of return from the investment that you've got, whether it be a positive return or a negative in terms of a risk assessment. And these guys have got amazing models that, and massive computing power that deal with that. Most of us managers sit in this space here, where we're looking for better than market returns, clearly. And there's less probability that can be assigned to the outcomes of those particular companies. And then when you get onto this piece here, there's that wonderful book written about a black swan. And that's the bit that you've got to figure out how you're going to deal with it, because the black swan is Russia invading the Ukraine. Black swan is a friend of mine who's got a equivalent of a cattle property in another country, in another continent. He had a tornado hit his property and wipe out everything, and they'd never had a tornado ever in the history of the country. And so they rebuilt it, and he said, okay, right, we're cool. Next year he had another one. So he had 2, which you might call a 1 in a million event, year after year. So these black swan events can happen frequently, although statistically they shouldn't, but you have to have a way of dealing with that in your investment process. And for yourselves who are looking to construct portfolios, you need to know that that's going to happen. Who would have believed that Lehman Brothers would have collapsed? Nobody in his right mind. If you had have said it 6 months before, somebody would have said to you, you're smoking something. I mean, that's impossible. One of the biggest banks in the world. So our investment philosophy is as follows, and I would suggest that anybody who's creating a portfolio needs to think about this as a way of doing it, which is really based on the economics of the business. And that drives the long-term performance. Now, in between that, you get what we would call the P multiple, which varies, and that determines the capital gain you're going to make 1 year to the next or over a 5-year period. But the underlying fundamentals of the business in terms of earnings and dividends is what drives it. And in our investment process, which I'll talk a bit about, we value the potential of the investment, not just the previous performance. But you do need previous performance in the way we look at things to get you to be able to decide you want to look at the potential. And it's kind of like picking the Australian cricket team. You would never go and pick somebody who had made ducks his whole life in the Sheffield Shield. You'd go and pick somebody who had made a couple of tons to open the batting. And that's the same with companies. You want somebody who's actually made a couple of centuries, and then you investigate them and you figure out whether they got the capability, the mindset, they've been training hard or whatever to be able to give you the potential that you're looking for. So we spend an inordinate amount of time getting rid of most of the stocks in the ASX, and we end up with a universe of around 100, 120 that we think are even worth looking at. And I sit at dinner parties and people say, oh, Manny, you're managing all this money, that's cool. I've got this stock here, tell me about it. So I have no idea, I don't even know what they do, never heard of it. So the point is that there are a lot of stocks for various reasons that we don't own, whether it be the balance sheet is too weak to be able to withstand the black swan events, whether we don't think the growth is necessarily there, or we don't have faith in the management team, or there's something wrong with the management team. I spoke at a conference last week where one of the questions was around Magellan. It's not one I'm going to talk about now, but I'd certainly happily answer our view on that one a little later. And I was in the press quoted quite often on Magellan, which is all about a quality business and a quality management team. And then the key thing is ignoring this temporary market turbulence. So you've got to be able to look through it, in my opinion, and take a view on where the business is going. And then you have to have a measure of value today to decide whether you're actually going to make money out of the investment. And if you can put those things together, then clearly this line here will drive your investment returns. And if the tables are anything to go by, the way that we do that certainly gets you pretty good returns. If you're going to make money out of anything related to the share market, and I would venture to say in most things, there's got to be a market inefficiency that you are exploiting, whether it be the ability of people to deliver their product. If people can't get it there and you can, you're going to make a lot of money out of it. Are there any things that we believe we exploit in the share market that gives us an edge? Well, there's two things. One, which is this growth anomaly, and we've got all the data that shows that on average, the market tends to undervalue the growth opportunity. They focus, and it might be part of the Australian psyche around franking credits, etc., but there is a segment of the market that concentrates on the here and now to get the yield into your portfolio. And to that end, Boyd, who's around here somewhere on his little stall, he's got a prospectus for one of the entities, ECP, which is currently issuing a convertible note. We've done two in the other two entities, which was taken up in a couple of days, and they trade. It's yielding 5.5%. It's a convertible note, so it's essentially debt unless you choose to convert it, and then you can convert it on one-to-one into equity into ECP. So for people that are looking for a bit of yield in the portfolios, it's actually fabulous. And if you have a longer-term view on the market, at the end of the period, you can convert it into equity, or you don't, or you get your money back. So it helps us to get economies of scale and reduce the expenses in the business, but it is an excellent opportunity. So the first point is this growth anomaly, and especially quality growth, is where we think that there's an inefficiency in the marketplace. And the second one is thinking long-term, especially in times when you've got COVID, when everybody's just focused on the here and now and where they can get their toilet paper, or you're looking at the war, which is at the front of mind every minute of the day. And I spoke at a conference some time ago, and it was an institutional conference, and the asset consultants who are the gatekeepers to our industry said they were talking about thinking long-term, and they wanted the managers to think long-term. And I was very quiet in the session, and one of the people said, "Oh, Manny, what do you think on this topic? You talk about long-term, how come you're not saying anything?" I said, "Well, I do think long-term, and I think it's the way to actually construct a portfolio. But if you were serious about thinking long-term, every contract that you have with us, you would convert it from 24-hour notice to 5-year notice. So you guys don't think long-term, but you want us to, and then you give us a contract that can be terminated daily. I mean, so get your thinking right, then come and talk to me, and then maybe I'll participate in the conversation." How do we go about it? We have adopted the 6-pillar process. Each company is subjected to a rigorous research process which looks at the industry, and part of what we look at there is whether the environment that it's in, the market that it's in, is big enough for the business to be able to grow. And that's where it comes back to this population story right at the beginning, is that the market has to be big enough. If you're going to be in a business that you want to grow its economic footprint, it can do that by claiming market share, but that means that it's highly competitive and maybe the margins won't be as big. You would prefer the market opportunity to be big. We clearly look at the business, and there's a lot of academic evidence, the Porter analysis, various other things as to how you look at the business, and we go into that in detail. The competitive environment is obviously important when you're looking at a business and who they deal with. Financials, well, that's where we start. As I said earlier on, we look at the balance sheet, we look at the operating cash flow to interest paid, we look at revenue growth, which is the second metric, and then we want a return on equity. So it's all important to start with the financials and decide whether they have actually made that century or they haven't. That's what tells you that. This piece here, in the case of Magellan, was the piece that was really important at the end of the day. And Hamish was an excellent operator through the years, and that's why we owned the stock up to a point. The more important piece these days is this segment here, sustainability. And it's been a part of our process since day one, but now these days it's becoming a bit of a buzzword. ESG is one of those things that you have to sign off on if you're a board member. If you're a trustee, it's all about ESG and how companies are looking at it. And because it's one of the key components in the way we look at investment, we have over time excluded certain industries from our investable universe, because we can't in all due conscience invest in gambling, weapons, pornography, tobacco, old forest logging, or pesticides. So we don't even touch them. But that's been inherent from day one. In the old days, it used to be slave labor. And if you want to have a sustainable business and you're using slave labor, well, even 20 years ago, that was not sustainable. So these criteria here are not sustainable if you're thinking long term. You can't be invested in a business that's dealing with that if you're thinking for the long term. This one here is very interesting. In my early days of setting up investment teams, I had a couple of analysts go out and visit a company, and they came back and we got to the management pillar, and I said, okay, well, you haven't written very much other to say that you've met the management and they look like very nice people, and oh, that's cool. I'm glad he was very nice. He obviously gave you lunch or something when you met him. It's all about those financial results that I was talking about, and who produced them. Oh, sorry. How do I go back?
The red one.
Sorry?
The red one.
Yeah, I did that.
Yeah, there you go.
Okay, right, there we go. The financial results that we were looking at to decide whether this is good enough to invest in, the question is, who was running the ship when they produced them? And if the management team weren't around for those 3 years, then you can't use them to make the projection. Because the captain is all important, the staff on the ship are all important. So that question that I had of those young analysts, I said to him, look, I think you better go back and have a look again, and let's analyze the management from a specific point of view as to, are they capable? And that's determined by the results they've produced. And we are taking that business model and that management team, and we're hanging our hat on them to take us into the future. So that is all important. This is one that's come to the fore, and we don't manage our portfolio for the carbon footprint. But we did get an external consultant called Foresight Analytics to analyze our portfolio and tell us, because there were people in our institutional client base that wanted to know how much carbon our companies were producing. So we did this, and we actually came out with 61 tons of CO2 compared to the ASX equivalent, which was 153. And there were only really 3 contributors to that carbon footprint in our portfolio of close to 30 stocks. It was Rio, James Hardie, and Costa. Now, Costa is the interesting one, because if you're going to exclude it from its carbon footprint, because of its carbon footprint, if you go to the UN website on sustainable farming practices and efficient delivery of food, Costa is one of the guys that's right up in the tables. So then it's a juggling act. Do you invest in them because they're actually a major driver of food? And we heard, and if you look at population, food's going to be a major problem as the planet, as the population gets bigger. Or do you want to exclude them because of the carbon? And our view is that because we're not managing specifically to carbon, but we do have a really good carbon footprint, we're happy to have capital into the Costa Group. The younger members of the team, they all tell me, Dad, and my one son's in the business, and the other guys, they come and say, oh, no, Dad, we've got to be signing up to these forums, et cetera, so we can see what's going on. So we are signatories to these. I actually have been a signatory to the principles of responsible investment for probably 20 years. I must say there's been a slight change to the nuance in the way they do things, but nevertheless, we're still a signatory. I was going to run an audience poll, but I still have 15 minutes or so, so I'm going to move on from that and just talk briefly to 3 stocks in the contents of population growth. Excuse me. We've got 3 stocks that clearly will benefit from an increase in population, not only in Australia, but across the planet. And one is IDP. And they are the people that essentially have a platform that students log on to when they decide if they want to go to university. And they can pick a Bond University on the Gold Coast, or they can pick Harvard Unit, wherever. And they can look at the course material, and they can see how they're rated. And that stock clearly is going to benefit from population growth, without a doubt. But also part of the driver to have parents around the world want their kids to be educated. And this is a global stock. They also dominate what's called the IELTS, which is the English language test. They recently bought out the other shareholders in that particular business. So they're at the fore. Oh, thanks. Actually, I did have some. I've got, thanks. Yeah. I just didn't want to break my train of thought. But so the interesting one is COVID did impact that business quite dramatically. Obviously, because students weren't able to move around. For us here in Australia, and Australia is a big part of this business, but it's by no means the dominant one going forward. The surveys that we are seeing, the whole border closures in Australia has damaged brand Australia, particularly for students. There have been students sitting outside this country for 2 years now that haven't been able to get in to come and study, and they've been waiting, and now they're going elsewhere. They're going to the UK, they're going to Canada, the US. So it is a problem what's happened, but I mean, we did what we did for the reasons that we did, but it's damaged brand Australia for sure. Lovisa. Those of you would have picked up a slightly different accent. I arrived here in '94 from South Africa, and I was rated as, in a number of areas, be it energy and diamonds. I suppose carbon was the common piece out of both of those. And to talk about Lovisa is kind of like heresy for me, because they're not in the the blue white $1 million diamonds. They're at the bottom end in fashion jewelry, high volume jewelry. And then you would say, wow, what happened to them in COVID? And yes, obviously people couldn't get to the stores, but people couldn't get to the other stores, and they were structured appropriately. And that's where I talk about the balance sheet, which is important. So they used their financial strength through COVID to buy up all the sites that they thought were really important because other people went out of business. So they've used COVID to enhance their global distribution, particularly in Europe. And now if you have a look at what's been going on, if you have a chart with one axis, which is 100%, and then you have services and you have product, through the whole COVID thing, we all know services declined by 30% because people couldn't go to the restaurant or whatever, but they started to buy product. But the product was not Lovisa's product. It was televisions, home gyms, all that sort of stuff that we did at home because we couldn't go anywhere else. But now that the doors are opening, these guys have got a distribution system made in heaven because they could now get to a lot of sites that they couldn't previously. And people have got money, as we've seen here in Australia. And now it's back to the old service model, and those are picking up, and they're ideally placed. But besides that, they were a really well-run business and probably one of the best in that high-volume fashion business. And you'll see their stores all over the place. Very small footprint. So that's one that we do own. This, I think, is it's been in our portfolios since year dot when they were like a 300 million market cap. And linked to population growth, obviously linked to superannuation and the expansion of superannuation. So 3 stocks, if you think that this topic is worth thinking about, those are 3 that are in our portfolio that benefit from the massive change in population that one would expect, although you're not expecting it in Australia clearly, but given superannuation and where that's going, this is a stock that we've had and we actually think it's fabulous. And it's all about technology, and they've been taking market share from the big players, which were the banks, as they were getting out of the space. And anybody who wanted to do anything online, these are the guys. So what you want, if you're investing with a boutique fund manager, is yes, clearly you want outperformance. I mean, nobody's investing to not make any money. And you want to ensure that when the black swan event comes, how well do these guys deal with it? So the 2 points that I just make here is that 61% of the time in rising markets, we do better than the market through our approach of focusing on quality businesses. But it also helps us in 57% of the time to outperform the market when it's going down. And that's the important part of the agreement, the ingredients. When you look at Hamish, I was quoted in the press where they said he's underperforming, and is that a concern for you? And I said, absolutely not, because he hung his hat on the fact that they protected on the downside. So if he's underperforming when the markets are going really haywire upwards, you would want to see him performing better than the markets in the down markets, which is what that was his mantra. So, I mean, I'm raising him because it just illustrates some of the points I'm trying to make. So as a fund manager, this is kind of a very important slide, is you want your capital to be protected on the downside, and there's another person who's going to be talking about that. But at the end of the day, when you have a problem that occurs in the world like we've seen now with the Ukraine and as we saw with COVID, all asset classes all of a sudden have a correlation coefficient of 1. Prior to that, bonds might do this, shares might do that, property does this, correlation coefficient maybe 0.6, 0.5. When there's a catastrophe, it's 1. All the boats go down. So you have to have something in your process that protects you, and at the end of the day, quoting Warren Buffett again, who quotes the book that was written in 1922 by Graham and Dodd's Security Analysis, where they said the only thing that protected them through the Great Depression was that their businesses all had strong balance sheets and had net cash. So for us, lazy capital is something that we don't like to talk about. It's all about the strength of the balance sheet and can it withstand bad times, which are happening all too frequently in our lives at the moment. This is just a snapshot on the 3 LICs. You can see ECP is a little more volatile than our straight broad cap portfolio. We have underperformed in the last couple of months because we're what would be deemed to be a growth manager, and we take the hit first and then everybody else follows. So we expect that over nearly 30 years in the markets, whenever there's a compression, be it the GFC, be it whatever it is, the growth stocks are the ones that first get hit. If you've got the capital and you know how to invest, when they get hit hard, you reinvest, and then the next couple of years actually gets you that outperformance. So since 94, which is this column here, we've done 14% versus the All Ords accumulation, which has done 8. Since inception of ECP in 2012, we've done 19 versus the Small Ords, which has done just short of 10. And in GFL, which is, as I said, 50% Berkshire Hathaway at the moment, it's done 9 versus the MSCI and Aussie dollars, which has done about 6. And that's the kind of outperformance you would expect of a boutique, and particularly over the long term. Somebody at Mercer once said to me, I want to see your 10-year data. I said, what the hell's that got to do with anything? He said, well, over 5 years is when we start to think that it's more skill than luck. But prior to that, it's just luck. So I would venture to say that we've got a little bit of skill because these are long-term track records that are more than 10 years. For people like yourselves, dividends are important, particularly fully franked dividends. And the intention has always been in flagships that we will grow the dividend at a rate faster than the CPI, which is all important. You want to keep your purchasing power. And that's what's happened to the CPI, and that's what happened to the dividend change, and a similar picture for ECP. Global doesn't pay a dividend at all because dear old Warren doesn't pay a dividend. He keeps it all to himself, and we need to pay some of the expenses. So the dividends we do get in are there to cover ASX fees and a couple of directors' fees, but it doesn't pay a dividend because he doesn't. And as we wean off Warren, probably there will be a dividend paid at some point, but not at the moment. As we stand here today, how do we see it playing out over the next 5 years? Because as a growth manager, we look at the next 5 years to determine whether we think we're going to make any money out of the investment. And what we look at is this internal rate of return. And people say, why an internal rate of return? Why don't you do a DCF or whatever, or a payback period? And the reason we do internal rate of return is because that's exactly what a yield to maturity is in the bond market. So if you're going to secure your capital by putting it into the bond market, and I would venture not into a bond fund because that's a trading fund, you would buy something and hold it to maturity, then you get the yield. If you're in a bond fund, you don't get the yield unless you hold it to maturity, and they're continuously trading. So it could be a problem where you could lose your capital. But this internal rate of return, as where we are right now, in our broad cap portfolio is close to 14, and in the ECP it's quite a bit higher, close to 17. What that means is if we grow at that rate or slightly better than that, so if we hit 15% over the next 5 years, and the historical returns have been close to what we've projected over the longer term, it means your money doubles every 5 years. That's what that means. How's that made up? So in the stocks that we own, 14% EPS growth. There is a dividend yield of close to 3 in some of the stocks, and we're actually looking from where we are now for the particular growth stocks that we're in. There's a contraction in PE. And you say, well, why would you see that in a growth stock, Manny? Well, because in 5 years' time, those companies might be mature, so we don't see them having the same growth profile. So that's the metrics of how it's made up. We have our booth outside, and please pop in and say hello to us if you wish. And if you would like a copy of this prospectus, if you're interested in 5.5% as a yield on a convertible note, pick up a prospectus. And I think I've got about 3 or 4 minutes for questions. So thank you very much for listening.
Manny, that was really, really interesting. I must admit, I have an affinity with your ESG screenings. I used to broker Indonesian stocks back in the 90s for a company called Bearings.
Oh, right.
Yeah, and they had palm oil companies.
Oh, yeah.
Very large ones, and I could never, ever sell them to my large institutional clients because I never believed them, anyway, that they weren't logging old growth forests. But anyway, I'd just be interested to know, in terms of your screening, you've discussed quite a lot about that. Is it all what we call bottom-up, so you do the stock picking, as opposed to any of the top-down? Do you look, for example, at a sector like electric vehicles and then try and look for a stock in that?
No, it's, as you said right at the beginning, it's bottom-up. We actually start with all the financials. We trawl the financials to see if there's something that would be of interest. And obviously there's new IPOs that come that don't have the track record, and then it's a lot deeper, the analysis. Where the macro overlay, and you'd say, well, gee, you're an economist, Manny, you're like a heathen in the space. But the macros come into when we're modeling for the 5 years. So each of those companies has a 5-year earnings, balance sheet, cash flow projection. And then clearly you've got to have a view on where you think the oil price is going, where you think currencies are going to go in the global, etc. So the macro comes into when we're modeling it, not when we're looking for something to invest in.
Right. And does liquidity, in terms of how much the turnover of the shares, does that have any play in it, particularly for some of the smaller growth companies?
So what I haven't spoken about there is what we would call risk adjustment. So all things being equal, we model them, we have an internal rate of return, and then a company that's got 25% internal rate of return gets a certain weighting. But clearly, if BHP's got an internal rate of return of 25 and Levisa's got the same, it can't have the same weighting because of liquidity.
Yeah.
So the risk adjustments we make are, liquidity is one of them. There's a couple of others, but that's one of the major ones.
Good, great. Now, I thought we'd just throw it open to the floor, and also to remind everybody this is a live stream, so thank you again to NabTrade. So any questions that I can pick up either on my live Q&A or any from the floor that anyone has? Yes, there we go.
Hi, I understand Warren Buffett is old, like 90 plus, but what is your main concern about that in terms of your medium-term view of Berkshire Hathaway?
Sorry, I couldn't hear that.
Basically saying that Warren Buffett is quite elderly, and is it just your view, why, I suppose, why you're divesting or trimming your position in Berkshire Hathaway? Well,
it's the same with every investment that we make, as I alluded to, is that it's an assessment of the success of the business model and the management team. And the management team in Berkshire Hathaway is Warren and Charlie Munger. And for those of you who maybe have had the fortune to go to the AGM, the Berkshire Hathaway one is just a big American sales fest. All the products are on display, and it's like a big family gathering. There was another company called Wesco, which had the same holdings as Berkshire Hathaway, was also listed, but it's no longer. They've taken it out. It was owned about 75% by Berkshire Hathaway. The difference was it paid a dividend, whereas Berkshire never did. And Charlie Munger used to chair that meeting in LA. And I don't mean to be unkind to Mr. Buffett, because he's obviously a genius, but the real brains was Charlie Munger, in my opinion. When you hear them talk and when you see them write, and you heard him on the stage. Now, Warren was not at the Wesco meeting. It was only Charlie Munger. And I laugh about this because he would sit here like me, and the place would be packed, not to the same extent as Berkshire Hathaway, and he'd say, the format of this meeting is it's a solitary soliloquy. What that means is I open the proceedings, I go through the resolutions, I ask the questions, and I answer the questions. And then he says, and so if I was sitting in the audience, this would be the first question I would ask. This is the question. And he says, right, I'll give you the answer. And that's how it proceeds. But I mean, I'm flippant. But absolutely, the questions were amazing. It was on the money, the ones that I went to. And you could see the intellect of that gentleman. So to answer your question, he's 90-something. Warren's knocking on the 90 door, maybe even there. When that guard moves on, yes, they've got some talented people, but we would want to see them at least have a period where they're running the ship and how well they do.